Greetings, everyone. My name is Frank Galdi, and I would like to thank you all for joining me today for the presentation, Defining Risk Within Investment Management. As you are watching this video, I hope that you and your families are safe and healthy. Given current circumstances, the virtual format that we're utilizing today is much different than a live presentation, so I will do my best to cover the topics effectively despite not having the typical interaction of a live audience. Before we get started, I thought I would begin by providing you a brief summary of my background, which provides me the perspective in the following subject matter. I've spent the vast majority of my career in the investment management business, which spans about 25 years. After cutting my teeth in investments in various analytical roles earlier in my career, I joined an institutional asset management firm where I led the development of a risk management framework from the ground up, staffing, analytical tools, establishing procedures, and integrating this process throughout the firm, and providing transparency to senior management. I was head of risk for nearly 8 years during the 2000s, and then in 2008, I joined New York Life to work for the chief investment officer of the firm as investment officer, evaluating investment strategies utilized for the general account, insurance products, and the pension plans. After a few years, I moved on to become the head of investments at the firm's wealth management division, where I was responsible for building out an investment platform, which included evaluating and recommending investment strategies that were utilized by our financial advisors. In 2014, I joined my current firm, Palisade Capital Management, as chief risk officer, and later assumed the responsibility of corporate development at the firm. In summary, I would like to emphasize the fact that I've been on both sides. The investment management side, overseeing proprietary product, which I do today, and also as an allocator of capital, or the person responsible for evaluating third-party investment managers and its strategies. For that reason, I have a unique perspective, and I will use this perspective today as I go through the presentation. I'll do it from the investment manager perspective, and also from the client or allocator, hiring the investment manager, which I assume is the role that many of you play. My objective today is to define risk within the context of an investment management business. This agenda that I'll follow will achieve this objective. I'll start out by reviewing a typical risk management workflow and process. Then I'll frame the discussion by breaking down risk management into 3 segments that should be considered and understood: firm or business risk, regulatory, compliance, and operational risks, which I include in the same category, and ultimately investment risk, which is the risk an investment firm is paid to take. I'll review these 3 main components with a focus on investment risk. Although there are many ways to categorize risk, my intention was to keep it simple and straightforward. An effective risk management program begins with a strong governance framework and sponsorship from the highest levels of management. For example, as Chief Risk Officer, I report to the Chief Executive Officer and the Board of Directors. I'm also a member of the firm's operating committee. It is critical for a chief risk officer to have direct access, influence, and a seat at the table. A strong risk management process has multiple layers and consists of multiple steps. The upper left section is where the process typically begins and will involve various functional areas of the organization. In this identification phase, it's important to interview members of various key functions of the organization. This is critical in compiling the inventory of risks for each segment. For example, the operations department typically conducts many routine and repetitive processes. As a result, the risk management team would partner with the operations team to review and evaluate each of these processes and to identify key risk drivers. It's also important to look forward and consider emerging risks that might present a problem in the future. Moving clockwise, next is the assessment phase, and where the analysis begins. It's important to note that depending on the type of risk being assessed, the process can be quantitative or qualitative in nature, and most likely a combination of both. It is also important to determine the potential impact of the risk exposures and ultimately confirm that it's consistent with tolerance levels. For instance, when analyzing investment risk of portfolio, measuring and evaluating it comparing to the benchmark is key. The risk of the portfolio will either be greater or less than the benchmark, It's important to understand the key risk drivers and exposures and that they are consistent with the strategy mandate and aligned with client expectations. Moving along, the next phase is the risk mitigation phase. Most risks are typically those that you want to reduce, particularly if they were unintended. Investment risk, on the other hand, is not necessarily one you want to eliminate, but rather optimize and make sure that it's maximizing alpha, or simply stated, value add. An investment manager must take risk in order to outperform the benchmark and achieve the objective. I'll cover this subject matter in more detail later in the presentation. In the final communication phase, the risk manager will address the key stakeholders, such as management, and most importantly, provide transparency to the client. I often refer to the evaluation of the performance results as the feedback loop. Are the results consistent with expectations given the market conditions? And for operations and compliance, did the business continuity or disaster recovery testing uncover any issues? There are so many examples that we could cover. Most importantly, senior management must be connected with the overall process, just as an investment portfolio manager must be aware of the risk in their portfolio on a regular basis to ensure that risk levels are consistent with what they intended and aligned with the investment strategy. Risk, the word itself sounds ominous, like something dangerous to avoid. So there are many types of risks. I simplified them into three key components or categories that I've outlined here. Firm and business risks. As I mentioned previously, every business faces risk. Threats from competition, changing landscape, failure to execute or implement your strategy, the list goes on. Bottom line is that in order for firms to stay in business and ultimately prosper, they need to deal with these risks and adapt to change. The retail business is a good example. Those that have not developed an online presence are having issues, and many have already gone out of business. Some risks are just too difficult to predict. Regulatory and operational risk. These risks are typically more obvious and risks that firms must get a strong handle on given how impactful they can be. If a firm does not have a robust governance and compliance framework and structure, they might be asking for trouble. The category of operational, regulatory, and compliance risks have been and remain the most significant threat to the investment management business. Investment risk. Well, within an investment management firm, it's not surprising that investment risk would be very important. Investment portfolio managers must take risk to generate returns to meet investment objectives. Not meeting these objectives is a risk in itself. I will cover this topic in more detail later in the presentation. Firm and business risk. Investment management firms, like any other business, must be well managed and have a strong governance framework, particularly a regulated business. The organizational structure is a good place to start. Separation of duties must be clear. Roles must be defined and free of conflict. For example, the chief compliance officer should report right to the top of the organization and have direct access. There should be no conflicts in his or her ability to present regulatory threats to the firm or have the authority to ensure that everyone complies with the rules. In smaller firms, reporting lines can be blurred at times, since one person may oversee various functions, which could be fine, providing there are no conflicts. When evaluating a firm, it's important to ask the right questions and understand the structure, workflow, and escalation procedures to confirm that there are no conflicts. A firm is defined by its culture. The investment management business, like many others, are dependent on people executing the strategy and implementing processes. Therefore, management and oversight is key. A strong culture of risk management and compliance is critical and should be an important part of an investment management's culture. A solid business infrastructure that's very organized and efficient is really important. An operational framework that's strong is critical for success. It's like the foundation of a building and the frame that supports the structure. Some other risks, like client concentration, is also another good example of business risk that's very important to assess and evaluate. Like many businesses, an investment management firm generates revenues by the fees charged to clients. It's important to evaluate client concentration risk and the percentage of revenue that each of the clients contributed. Risk managers and chief financial officers track these metrics and should have the information readily available for clients performing due diligence. A clear and organized business strategy for growth is important, and the absence of one can be a risk as well. If a firm does not have a plan to grow, they're likely to fall behind, which could pose a serious problem in the future. Succession planning. It's the last point I'll make in this risk category, because the importance of succession planning is to mitigate overall business risk. Each firm should have a succession plan if a key person is no longer able to perform their duties or leaves the firm. While losing a key member can impact a business, every organization should have a comprehensive plan to ensure the continuation of the business if there's a change of a key member of the leadership team. This highlights the importance of training and having a deep bench of talent that is available if and when the time arises, or just a natural part of the progression of a business. Now I'd like to discuss business risk specifically as it relates to the portfolio management team who's responsible for managing the investment strategy. Key person risk within the portfolio management team is significant, particularly when assessing the risk associated with a change of the lead portfolio manager of a strategy. How the strategy would be impacted if there were a change is why succession planning here is also critical. Many clients will often put a firm on watch if a portfolio manager leaves the firm. While most portfolio managers are bound by contracts and non-competes, most investment firms assign either a co-PM or an associate PM that can manage the strategy on their own to mitigate key person risk, like a pilot of an aircraft and the importance of having a co-pilot, so to speak. It's also important to address incentives. While there might be the best of intentions, compensation of the portfolio management team must be aligned with investors to avoid potential conflicts. Key performance indicators aligned with client interests typically serve as the basis for the compensation structure for the portfolio manager and their team. The depth of the team and the ground that each member covers are important to assess. No one is superhuman and can cover too many areas. This is something that a risk manager and those evaluating an investment firm and investment strategies need to consider to ensure that there's appropriate coverage. Regulatory and operational risk. Well, these risks are critically important to assess and manage. This is true for the investment management business and for most businesses for that matter. Regulatory and compliance risk in particular is an area that could fill an entire agenda, given its importance and level of complexity. Failure to comply with the rules and regulations could certainly put a firm at serious risk or out of business for that matter. Therefore, a robust compliance program is critical and required. The Chief Compliance Officer of an investment management firm is a critical resource and an individual who is responsible for developing the compliance program and ensuring compliance with the appropriate laws and regulations. Business continuity planning and disaster recovery are just some examples of what would be included in a compliance program, given the impact that it could have to the business operations. Cybersecurity risk is prominent. It's prominent in our lives, and it's been taking center stage as a result. It's been mandated by the SEC that firms have a program to address these very serious risks. Firms have enhanced policies and integrated technology to deal with these threats, which are real and can be very impactful. Given the importance of regulatory and operational risks, consultants and clients perform operational and compliance due diligence reviews for investment management firms that they do business with. This will often entail on-site visits and completing questionnaires. These are performed at the inception of the relationship and on an ongoing basis. Operational infrastructure must be strong and leverage technology where appropriate. The infrastructure must be strong, otherwise it can increase potential and unforeseen risks. It is important that firms take necessary steps and invest in technology to keep up in this area. Manual processes must be kept to a minimum. I often say that cheap can be expensive and expensive can be cheap, meaning that sometimes not investing up front can cost you more in the long run. The recent pandemic has put the operational and technology infrastructure to the test. We've had a stress test past 9 months or so. This environment has highlighted the importance of technology and a strong infrastructure. So far we've reviewed risks, business, regulatory, compliance, and operational, which go hand in hand. What is common with these risks is that they should be reduced or mitigated as much as possible. Investment risks for an investment management firm are different in the sense that risk must be taken to generate returns and achieve an investment objective. As a result, investment risk or market risk must be optimized and consistent with the investment strategy mandate and within the client expectations. And these risks must be consistent with the investment philosophy and approach, and in most cases, an investment strategy is compared to a benchmark. Active risk or risk versus the benchmark and key risk drivers of this risk must be understood and will serve as the basis for evaluating the performance of the strategy versus the benchmark. An investment risk process, which is a key component of the investment management of the strategy, must be integrated. This is typically how and where the collaboration between the portfolio manager and the risk manager takes place. Investment consultants and clients conduct rigorous due diligence and research to evaluate the investment philosophy and the process, which define an investment strategy. This will set expectations at the onset of the relationship. I'd like to now begin to dive into investment risk by starting out with one of the more common risk measures and one that is familiar to most, given that it's a metrics by which most define investment risk on both an absolute and comparative basis. Standard deviation measures the dispersion of returns relative to its mean or historical average. A higher standard deviation means that the returns are more dispersed, illustrated on the left chart. Lower standard deviation means that returns are less dispersed, illustrated on the right chart. If there is more variability or dispersion, there's generally more uncertainty and thereby more risk. There's higher risk. Standard deviation of returns is a very common metric that is used to compare one investment strategy versus a benchmark or other strategies. Equities or stocks generally have greater fluctuations in price and therefore are more volatile than bonds. Volatility is okay, providing you have a longer time horizon, whereas permanent capital loss is just that, permanent. It's not coming back. Benchmark risk is relevant to active managers whose objective is to outperform an index. Tracking error is the metric that is used to quantify how closely a portfolio tracks the benchmark. The standard deviation of the active returns, portfolio returns versus the index, is the tracking error. High tracking error means that the portfolio does not closely track the benchmark, whereas low tracking error means that the portfolio more closely tracks the benchmark. The key here is to managing expectations. Historically, if a strategy has a low tracking error, but more recently you see the strategy has been significantly outperforming the benchmark, you'd want to understand why. It's always about setting expectations and following up and analyzing performance to make sure they're aligned and consistent. The purpose of risk-adjusted return metrics is to evaluate the level of risk taken to achieve investment returns. A key ratio that measures this risk reward is the Sharpe ratio. The Sharpe ratio is computed by taking the investment strategy return minus the return of a risk-free instrument, such as the 3-month T-bill, divided by the standard deviation or level of risk. The higher the Sharpe ratio, the better. For instance, if two strategies generated the same return, basically in the numerator, but one had lower volatility, then the strategy with lower volatility would have a higher Sharpe ratio because it achieved the same return by taking less risk. In the illustration that I have here, you will see that firm A, or strategy A, has a higher return than the benchmark, 8.6 versus 8. And not only did strategy A outperform the benchmark, but it achieved that with less risk, and therefore has a higher Sharpe ratio. This is a great measure for comparative purposes and important to look over longer periods of time. Now let's review the risk of losing principal or permanent capital loss. Now this is relevant for bonds. When you purchase a corporate bond, or an issuer has an obligation to the buyer. Credit risk is the risk related to not getting paid the principal and interest on a bond. Bond credit ratings provide insight to understanding that risk. Investment grade are highly rated bonds where credit risk is lower, and yield is lower to compensate for the lower risk. The lower the rating, generally high yield and below investment grade bonds, the coupon or yield is higher to compensate for the higher risk. If an issuer defaults, that could lead to permanent capital loss. Rating agencies provide credit ratings on bonds and can upgrade or downgrade a company's rating depending on their view of the credit and the probability of default. In an environment where yields are low, investors sometimes have the tendency to want more yield and might be inclined to take on more risk. That's why a professional fixed income manager has experts, credit analysts, that evaluate credit risk and make sure they're being compensated for the risk taken. The primary objective is fairly simple: to get paid your principal and interest. Before I move on to some of the tools and other measures that a risk manager might utilize, I'd like to introduce the concept of investment strategy style and portfolio characteristics. I'll use an equity strategy as an example. Investment managers have certain philosophies and processes that define their investment strategy. For instance, equity managers may emphasize certain financial characteristics within their universe to outperform the benchmark. They may seek certain attributes that also may lead them to overweight certain sectors or industries compared to the benchmark, or underweight them. Certain financial characteristics, like lower leverage, higher profitability, may result in less return volatility compared to the benchmark. These attributes and characteristics define an investment manager's style. Investment consultants and clients evaluate the investment process and set expectations from the onset to basically understand how the strategy would perform in certain market conditions. There are various tools, such as risk factor models, that investment managers and consultants utilize to decompose sources of risk versus a benchmark and to ensure alignment of the strategy process and the risk factor exposures. This slide illustrates an example of a risk factor decomposition of an investment strategy versus the benchmark, utilizing an equity risk factor model. Again, these models that risk managers use to measure risk versus an index and decompose the source of risk to assure the alignment with the investment strategy and process can be quite complex. However, I'm going to try to simplify it as best I can to familiarize you with these important tools. This model estimates an investment portfolio's risk versus the benchmark or tracking error on a predictive basis and decomposes the source of this risk into certain factors. In this example, you'll see that the portfolio has less risk than the benchmark, and the predicted or ex-ante tracking error is around 3.5%, highlighted in yellow on the upper right. On the chart on the left side, the model has determined that risk factors, some style, some industry, are contributing approximately 48.6 of the risk, which is highlighted in yellow near the top. Versus the benchmark, you'll see, which is 51.4%. So that risk can be attributed to stock-specific risk or non-factor risks. Again, very complex, but just a good example to see a typical dashboard that a risk manager would use. Now, utilizing the same model, a risk manager will often use the same tool to evaluate performance versus the benchmark to understand how the risk factor exposures have impacted performance versus the benchmark. I usually refer to this as the feedback loop because this process helps to tie the portfolio risk exposures and the positioning to the actual results to determine how much of the return can be explained by the investment strategy style, versus the specific risk associated with the stocks themselves. No model is perfect, but it's a useful tool in framing the discussion with management and clients, which is part of the communication phase of the risk management process, which I reviewed earlier in the presentation. So today I've covered a lot in a relatively short amount of time, and I've tried to keep things at a fairly high level. I want to leave you with a few takeaways before I wrap up this presentation. Every business faces risk, and risk management is multidimensional and a multi-layered process. I've defined risks associated with investment management firms into business and firm risks, regulatory and compliance and operational risks as another segment, and ultimately investment risks. A strong governance framework is critical, and a robust compliance program is a must. Risk management processes are both qualitative and quantitative in nature. There is no silver bullet for measuring all risks. You need to take a mosaic approach and utilize various tools to really get a handle on what's important. Investment risks, the risks that an investment manager gets paid to take, must be optimized and ultimately aligned with the investment process and consistent with the strategy mandate. These risks must be measured, monitored, and communicated on a regular basis to ensure this alignment. And they must provide the appropriate level of transparency to clients. As I typically give these type of presentations to a live audience and make it interactive, I hope that this worked out well for everyone, despite not having the interaction that I'm typically used to. I appreciate your time today. Thank you.